$2 trillion. That's not the annual GDP of a small nation. That's the amount corporate America is about to hand over in repatriation taxes, and it's about to fundamentally restructure how dividends work for the next 18 months and beyond. If you've built a retirement around dividend income, living on a steady 3% yield from a $500,000 portfolio, collecting $15,000 a year, the next 18 months will test that math harder than any bear market correction. And here's the thing. The culprit isn't a recession. It's not inflation spiraling out of control, and it's not geopolitical uncertainty. It's a tax policy that most dividend investors never saw coming, and it's already reshaping corporate capital allocation decisions in boardrooms across America. In the next 9 minutes, we're breaking down the exact mechanics of this repatriation tax, examining specific examples of how it impacts real companies and real portfolios, and showing you precisely how it will compress dividend yields across every major sector, from energy to healthcare to consumer staples. Let's start with the basics, because understanding the mechanism is crucial to protecting your portfolio. When we talk about repatriation taxes, we're talking about something that's actually been on the regulatory radar for years, but the 2024-2025 version is dramatically different in scale and immediate impact. Here's the scenario. American corporations have approximately $2.6 trillion in cash sitting overseas in foreign subsidiaries. That's money earned abroad, sometimes through legitimate operations, sometimes through complex tax strategies, that hasn't been brought back to the United States and subjected to U.S. federal taxes. Under the new policy framework, these corporations face a one-time repatriation tax of roughly 15% on that accumulated foreign cash. For a company like Apple, which holds approximately $95 billion overseas, or Microsoft, with roughly $70 billion parked internationally, this isn't pocket change. We're talking about $14, $25 billion for Apple alone, and $10, $5 billion for Microsoft. Even smaller companies in the S&P 500 are looking at bills ranging from hundreds of millions to low single-digit billions. Now, here's where it gets critical for dividend investors. Corporations have exactly one fiscal year, roughly 18 months for most companies, to make a strategic choice. They can pay this tax and repatriate the money, bringing it into the United States where it's subject to additional state taxes and where they need to deploy it productively. Or they can keep the money overseas and pay the tax incrementally as they naturally bring profits back home, which stretches the pain across many years but avoids the immediate cash crunch. Most large corporations will choose to pay the bulk of it upfront. Why? Because sitting on $2 trillion in international cash becomes increasingly untenable under scrutiny from shareholders, regulators, and the public. The reputational cost and operational complexity of maintaining these offshore structures eventually exceeds the tax savings. So what happens when trillions of dollars suddenly need to be deployed by corporate boards? This is where the dividend versus buyback decision becomes absolutely critical. Let's look at a concrete example. Johnson & Johnson currently pays annual dividends totaling roughly $5 billion to shareholders, one of the largest dividend programs in corporate America. The company has been increasing dividends for over 60 consecutive years. But J&J also faces a potential repatriation bill in the $5-7 billion range. In this scenario, J&J's board faces a real choice. Do they maintain their historic dividend growth trajectory, or do they pause dividend growth to preserve cash for the tax payment? Historically, during the 2017 Tax Cuts and Jobs Act repatriation event, we saw exactly this play out. Companies had roughly $2.9 trillion in foreign cash at that time. Some chose buybacks. Cisco spent $25 billion on repurchases in the years following. Others chose dividend increases. Procter & Gamble increased dividends 5% year over year. The choice varied by industry, maturity level, and growth prospects. But here's the crucial difference in 2025. Interest rates are significantly higher, growth projections are slower, and corporations have already been conducting massive buyback programs for the past 7 years. The Federal Reserve's quantitative tightening has made raising debt more expensive. The dynamic is fundamentally different. According to data from FactSet, in 2023 alone, S&P 500 companies spent $882 billion on buybacks, a record. They're already returning capital aggressively. When forced to choose between maintaining that momentum and maintaining dividend growth, many will pause the latter. Let's examine how this plays out across different sectors. Energy companies, which typically pay some of the highest yields, face particular pressure. ExxonMobil, for example, yields approximately 2% and has substantial international operations, particularly in the Middle East and Southeast Asia. The company's tax bill could easily exceed $8-10 billion. While ExxonMobil has the cash flow to manage this, every dollar spent on repatriation taxes is a dollar not spent on increasing the quarterly dividend or funding buybacks. With energy prices potentially softening and capital intensity in the sector remaining high, dividend growth could decelerate. Consumer staples companies like Coca-Cola and PepsiCo operate extensively overseas, generating meaningful portions of revenue from international markets. Coca-Cola derives roughly 60% of its revenue internationally. The company's repatriation tax bill could approach $5 billion. The company has been a dividend aristocrat for decades, increasing dividends annually. But with this one-time hit, Coca-Cola may need to moderate the growth rate of those increases. Technology companies present an interesting case. Apple, Microsoft, and Alphabet all hold massive amounts of cash overseas, but they also generate enormous domestic cash flows. These companies have the capability to absorb the repatriation tax while maintaining dividend growth, though it may be slower than previously expected. However, they're also under shareholder pressure to invest in AI infrastructure, research and development, and strategic acquisitions. A repatriation tax creates a competing capital priority. Here's a concrete walkthrough of how this impacts a retirement portfolio. Let's say you built a dividend strategy around 5 core holdings: a utility company like Duke Energy, a consumer staple like Procter & Gamble, an energy company like Chevron, a pharmaceutical like Bristol-Myers Squibb, and a rate like Realty Income. Duke Energy yields approximately 1% and generates most of its revenue domestically. The repatriation impact is minimal, maybe 2-3% of cash flow. Dividend growth likely continues at historical rates. Procter & Gamble yields 4% but derives approximately 40% of revenue internationally. The company's tax bill could be $3-4 billion. This likely means dividend growth moderates from the historical 5-7% annually to perhaps 3-4% for the next 2 fiscal years. Chevron yields 8% and has massive international operations. The repatriation bill could be $4-6 billion for Chevron. Combined with commodity price uncertainty, dividend growth becomes dependent on oil prices, more volatile and less predictable than usual. Bristol-Myers Squibb yields 2% with substantial international pharma operations. The tax bill hits hard, potentially exceeding $2-3 billion. Dividend growth becomes a question mark for 2025-2026. Realty Income yields 7%, but generates most income domestically. This rate is relatively insulated from repatriation impacts, so your blended portfolio yield doesn't change immediately, but the growth rate of that yield, what you're counting on to beat inflation, absolutely compresses. If you were modeling 4-5% annual dividend growth, you might actually see 2-3% growth for the next 18 months, creating a real drag on your purchasing power. Now, let's address some counter-arguments and nuances that deserve attention. First, some argue that the repatriation tax is actually economically stimulative. By forcing capital back into the U.S., it could theoretically increase domestic investment, hiring, and productivity. There's merit to this argument from a macroeconomic perspective. However, it doesn't change the near-term cash flow impact for individual dividend investors. Second, some suggest that corporations will simply raise debt to finance the repatriation tax, keeping dividends and buybacks unchanged. This is possible, and some companies will do exactly this. However, with the 10-year Treasury yielding above 4%, the cost of debt is substantially higher than it was in 2017-2018. This makes debt financing less attractive and less likely to be the universal solution. Third, one might argue that buyback-funded equity growth provides returns that dividend-funded returns don't. And that's technically true. If buybacks reduce share count, earnings per share grow faster, potentially driving stock price appreciation. However, most research suggests buyback returns and dividend returns roughly equalize over long periods, especially when accounting for taxes. For retirement income specifically, buyback-based returns require you to sell shares, less tax-efficient and less predictable than dividends. Finally, there's the argument that repatriation is a one-time event and shouldn't materially impact long-term dividend investors. And that's partially correct. After the 18-month repatriation period, companies will return to normal capital allocation patterns. However, that's little comfort if you're currently dependent on dividend income from a $500,000 portfolio, and you're suddenly seeing 2-3% growth instead of 4-5%. What should dividend investors actually do with this information? Several concrete actions make sense. First, audit your dividend holdings and quantify the exposure to foreign operations. Companies with 40% plus foreign revenue face larger repatriation impacts. This doesn't mean avoiding them, but it means acknowledging the risk. Second, consider adding domestic-focused dividend payers, utilities, regional banks, and domestic-focused consumer staples companies. These firms face minimal repatriation impacts and can maintain normal dividend growth. Third, diversify beyond dividend stocks entirely. The best dividend portfolios aren't 100% dividend stocks. Adding growth stocks, bonds, and alternative income sources creates resilience. Fourth, revisit your safe withdrawal rate. If you've been modeling 4% annual withdrawals from a dividend-focused portfolio, this 18-month period might require moderating to 3-5% until dividend growth normalizes. The $2 trillion repatriation tax isn't a disaster for dividend